I hated working in the oil industry. That was simply like working for a paycheck, 100 hours a week. It sucked.
Yep.
And I was able to outsource that job through passive income using real estate as the vehicle. That never would have happened if I had followed the traditional investing advice of buy low, sell high.
We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the Cash Flow Pro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to the Cash Flow Pro podcast. I am here today with Travis Watts of Ashcroft Capital. I know Ashcroft is a leader in this space, and I'm really excited to dive in here with Travis to see exactly what they've got going on and exactly what they might be able to do to help you facilitate your investment needs, your investment wants, or whatever they have going on. Travis, welcome. How are you today?
Casey, thanks so much for the invite. I enjoyed our chat here before the show and looking forward to it.
Absolutely, man. This is something, like I said, I've watched Ashcroft from afar for a long time, just to, at some points, even at the best ever conference, learning and just seeing how all of these pieces kind of fit together and how this whole setup came to be. So, I guess I'd like just a little bit of backstory on maybe yourself, and then maybe even how that kind of translated into, hey, let's go with Ashcroft Capital and make this and build this business. So tell us a little bit about your backstory and how you got to where you got started.
Sure. Yeah, happy to. So, a lot of folks in the real estate space get started in single family homes, and that was my story as well. It started with not having mentors, not listening to podcasts, not coming from a family of real estate or investors, and just trying to figure it out, man. Like I like a lot of people, I read the Robert Kiyosaki books and things like that, and I thought, okay, cash flow, passive income, tax advantages, it all sounds good to me, but I don't know what I'm doing. And so, it started with some house hacking, having a roommate, that effectively paid my mortgage on my first property. And I thought, well, that's pretty cool. I didn't have to work for that income. What if I could scale that up somehow? How do I get 100 of these checks coming in every month, not just one from a roommate? And so I got into fix and flips, vacation rentals, buy and hold single family. I did a whole bunch of stuff for about 6.5 years, from 2009 to about 2015. And then something really kind of crazy happened. I was, by the way, I was working in the oil industry at that time just to make as much money as I could make. And I was being extremely frugal, and I was putting all of this extra money into real estate, at a good time in the market. As you know, started hitting a recovery around 2011, 2012, something like that. Yep. So, I'm building it up, and I finally decided I need some more education, right? It's really tough to scale to 100 single family homes. I had this thought in my head, I'm going to get 1 or 2 properties a year for whatever, the rest of my life, or for 20 years or something. And it just really got difficult to do that, And so I thought, okay, I don't know what I don't know. Obviously, some people are at a much higher level in this real estate game than what I'm trying to do. And I couldn't really articulate that very well. So I joined this big meetup group. It was out in Boulder, Colorado. And I was introduced to a couple gentlemen in their 60s and probably early 70s. And they had sold their companies in the mid-1990s. And they became full-time passive investors. And that was a foreign concept to me. I didn't even know what that meant. What do you mean a passive investor? And a lot of what they were investing in were real estate syndications, funds, individual deals, this kind of stuff. And so this was a big eye-opener, because I finally realized that I can be in real estate. I can get tax advantages. I can get monthly income. I don't have to find these properties. I don't have to do the underwriting. I don't have to manage tenants. toilets, termites, this kind of
The
stuff.
three T's.
The three T's, and so there are many more than three.
Yep.
And and so this was kind of what I needed at that time in my life. I needed to free up some time, and I love real estate. I'm passionate about it. I just wasn't passionate about swinging a hammer and managing tenants.
Sure.
So yeah, man, that's where it all changed. 2015, I was like, all right, I'm going to try this out. I'm going to be a limited partner in a syndication, and I'm going to see how it goes. Took about 6 months, did one deal, sat back and watched, wanted to make sure it wasn't a scam. I didn't want to dump all my money
Yep.
into something and not know what I was doing.
Yep.
And so I was skeptical, in fairness. And, it worked out. The reporting came through, the distributions came through. I started seeing the light at the end of the tunnel, so to speak.
Yep.
So, since that point, I don't know how many deals I've done, 40, 50 deals as an LP, I don't know. And a lot with Ashcroft Capital. And so, and a lot with other operators, quite frankly. I'm big into diversifying in different markets, different business plans, different asset types, etc. So how it came to be is Joe, I was investing with Joe just as one of these, partnerships in several deals. And Joe Fairless had his daughter Quinn about 2.5 years ago, and leading up to that, he was on the road a lot. He was doing podcasts and webinars. He was on stage. He was doing all this stuff, and he kind of lost the desire to do that with a newborn at home.
You can take it from you real quick.
It was just it was just a timing thing, And I'm like, Joe, I love these conferences. I love networking. I love educating. Let me take some of that off your plate. Let me try to fill that role. Call it whatever you want to call it. So we called it Director of Investor Relations. And we've since built out an entire arm of investor relations over at Ashcroft. But that's kind of how it came to be. So I started as an LP investor, kind of worked my way into, that's how I added value to him and to the company. And so, yeah, man, now I'm just out there, doing webinars and conferences. I did 2 big speaking events yesterday. I was also at Best Ever Conference. I just go out and try to help who I can help when I can help. And
sure,
so that's
lead
kind of
with
how
value. It sounds to me like you all have got the lead with value kind of lined out there. And if you have the want to and the passion to go out and just simply educate. I mean, that's what we're here for. We're not here we're here to educate people so that they can have, so that they can show up with the tools that they need and don't have to be, I heard a guy tell me something a long time ago and it really resonated with me. And if you have to drag people in, you have to drag them around. And the thing is that if you catch somebody too far or too early in the process of them learning, then essentially they're just being sold. They're essentially being dragged in. So if you can educate and lead with value, show that you're a company of great morals and ethics and everything else, then people just tend to come on and go with you. So, much like your story, mine was the same way with the single family. Oh my Lord. I would wake up in the morning and I would just say, okay, what's going to go wrong today? Because it was just, there was 4 walls at every house rather than 4 walls with, whatever, how many people living inside. And so the scalability was just virtually, I hit a tipping point where I was like, all right, this I've had it. I can't do this anymore. So the same way. So when we bring your story up and you're like, okay, hey, I'm going to start working with Ashcroft and Joe Fairless, and I'm going to start looking in this direction. I guess you went through your aha moment of saying, wow, this is, I could scale this and all of that kind of stuff. But let's go a little bit deeper into that. I mean, as from an LP perspective, now, are you GP on some deals too? Like, I mean, obviously you said you're Director of Investor Relations, which is what the title is, but are you actively involved in any of the management and the other side of this token?
Good question. I'm not. So I'm a full-time LP. Every investment in my portfolio, real estate or not, is 100% hands-off and passive. So I went one extreme to the other. It's something to point out that I do all the time for people. Most people don't do what I do, in that they're either full-time active to full-time passive. Most people are kind of a hybrid blend. You might be toying around with some of your own projects or flips or vacation rails, but then syndications could be added on to that to help scale passive income. So.
Sure. So for the people out there that may be aspiring to move into this space, as far as I guess one day at one point be our competitors, what advice? Now I know a lot of people try to get speaking gigs, and a lot of people, of course, you have to start somewhere, like we with our podcast, and just kind of build out from there. But you mentioned that you had two big speaking engagements yesterday, and that kind of stuff. But how do you facilitate all of that along with everything else that you've got going on?
Yeah, so I launched under Joe's podcast, the Best Ever Real Estate Investing Advice podcast. I launched a show. It's once a week episode I record called the Actively Passive Show, and it's kind of the irony behind there's still a lot of active components to being a passive investor. And so my message to the world is this, passive income, if you're really an investor focused on passive income, cash flow, interest, dividends, whatever you want to call it, then it allows you, as you build that up, to spend more time doing the things that you love, doing less time on the things you don't enjoy. And that was kind of my whole story, because I hated working in the oil industry. That was simply like working for a paycheck, 100 hours a week. It sucked.
Yep.
And I was able to outsource that job through passive income using real estate as the vehicle. That never would have happened if I had followed the traditional investing advice of buy low, sell high.
Sure.
Right? Put your money in an index fund, and when you're 65, take a peek and hopefully you're good.
Yep.
I don't follow that at all. And I never have. And so I think that's the biggest lesson learned. So how do I manage it all? Well, first of all, I'm grateful to have an opportunity to really be able to focus on the things that I truly, genuinely enjoy. Like, for example, this podcast we're doing right here. I'm not paid to do this podcast. Yep. I mean, you're not paying me. Joe's not paying me to do this podcast. I choose to do these for educational purposes because it's what I enjoy. Same with his podcast. I'm not actually paid to do that. I just do it because I need to vent out the information that I consume on a weekly basis to people, and I try to simplify and make it easy for them. So it's great to find the win-win situation. So I don't have a traditional schedule. I do, like yesterday was a busy day. I did 2 back-to-back big conference events. Today's your podcast and like 3 or 4 investor calls. Tomorrow I really got like nothing on the books. So my days are kind of like that. I have a little Calendly and little, Google Calendar, and it is what it is. I wake up in the morning and what do I got going on? So
Hunter Thompson told us a couple of weeks ago, he said that he was interviewing for what was I forget, it was an executive assistant or something maybe, and this executive assistant had come from a big corporation, and she had never heard of Calendly. He was like, this lady was getting paid $100,000 at a corporation to manage somebody's calendar, and she was like, I sure hope these big executives don't find out about that. But nevertheless, so let's talk a little bit about how you. I want to know more about these LP partner, the limited partnerships that you're in. As far as like, how do you pick an operator? Are they all with Joe, or obviously you had mentioned diversification, so I assume not. I assume you have them other things that you're invested in passively, and how you choose operators and what you look at and what kind of qualities you like to see. I mean, I think we all have our list of things that we like to see up front, but then when you dig in and you say, oh, hey, maybe I don't like this or that, but what's some of the stuff that you look for in a good quality operator?
Yeah, and for everybody listening, it's really important to identify your own criteria based on your own objectives and your own goals. And I'm happy to share mine here, but they may not be relevant to everybody, right? If you've got a completely different perspective on things. So for me, it actually starts, believe it or not, having very little to do with investing and really nothing to do with real estate. That's where my criteria starts. And it was being raised by parents that believed in buying something used or cheap or at a garage sale or on Craigslist and fixing something up and selling it for a higher price, later on. And whether we're talking about a vehicle and car, I was just raised with, never buy a brand new car off the lot. Just don't do
Absolutely.
it. And, so find that car through a relationship or a friend or a family member you can buy for cheap and fix it up and use it. And, and that worked. There were vehicles through high school and college that I made money on, and I had put 50,000 miles on them,
Yep.
so,
Yep.
so it
Everybody else
just
was losing
made,
it. You were making it.
yeah, exactly. It just made logical sense to me. Okay.
Yeah.
And again, that's not everyone's story or experience or opinion. And so that rolled over into real estate, even when I did single family. So I would try to find an off market or a bank owned or a beat up property and try to fix it up and either rent it out, make it a vacation rental, or flip it, depending
Sure.
on what its best potential was. And so that carries us into these syndications. So to answer your question, my criteria is about Class B properties primarily. I've invested in C's and B's and A's, and we're talking about the age and the demographic and the quality type of the asset. But my sweet spot's been B, and so it's kind of finding an operator that's going to find like a B minus that's a little outdated but still has some good structure, bones, and amenities, and sprucing it up again to the current market standard and redoing amenity spaces and units and clubhouse and landscaping and signage and all that good stuff,
Sure.
adding things it didn't have before. So it's a value add plan that's usually the hold periods between probably 3 and 7 years.
Yep.
Sweet spot's kind of 5 years. And the markets I tend to like the most, again, I invest in a lot of markets with a lot of operators, but it's the Sun Belt markets.
Yeah.
So I've done a lot of Texas and Florida and Carolinas and, oh gosh, I don't know, Phoenix and just all over the place, Sun Belt markets. And then what else can I tell you about? 200 to 600 unit size properties, generally speaking. I have invested in some smaller ones. Not a whole lot that's bigger other than some portfolio purchases and stuff like that.
Sure.
And so, it's just, again, it's buying something hopefully off market or at a discount or below market rents or whatever you want to say about it, having them fix it up, make it better, improving it, and then hopefully there's some value there. But the main point is everything I invest in has a cash flow emphasis. So I never invest in new development, and nothing against that stuff. It doesn't match my risk tolerance, and it doesn't meet my objectives because I live on cash flow. So it doesn't cash flow. Why would I do it? That's kind of what it is.
Especially if something you got to hold and put a bunch in up front, and then you have market risk during that period, and you have. Yeah, I mean, it makes perfect sense. And like you said, there's nothing wrong with it, but that just, and I'm a big proponent. Like, as a matter of fact, when somebody comes in and sits down, I am a huge proponent of them defining their risk profile. They have to decide, I am X number of years old. This is what I have to invest. And then, of course, diversifying from there. When you say, new construction, the risk there is probably a little bit higher than something that's existing that has active cash flow. But again, you're almost your 2 to 3 year period there while everything's being built, especially if you're building something that's 400 or 500 units. It just doesn't tend to flow, and it doesn't fit a lot of people's risk or their market tolerance. You know what I mean?
Yeah, and it's a great thing you bring up because in private placements, they're usually an illiquid investment. And so the last thing you want to do is look at some shiny numbers on a piece of paper and go put 100K in a new development and then a year and a half in realize, we might be in this thing for 5 years and I'm not going to see that money until then, or if I see that money.
That's
That could be a little unnerving to sit years on that and just hope and pray. And it's kind of like the buy low, sell high mentality. I don't subscribe to it, but that's just my preference. So.
Yep. And and again, somebody that has $10 million in the bank, and again, it all comes down. That's the other thing that we, when we're talking about this stuff is deciding what your economics need to look like. And if you have if you have plenty of other money to live off of, and $100,000 investment that's going to set 5 years is not going to be a huge deal. But if you're like, hey, I got $500,000 to invest, I'm going to put 250 into something like that just sits there. I mean, that can be, like you said, yeah, that could possibly cause some sleepless nights later on down the road. But nevertheless, it is for some, it's not for others. So let's kind of transform here just a little bit and discuss, where do you envision? Obviously, you're going to just continue building a little layer at a time. But is there any big hurdles or any big things you see kind of coming down the pike that you're gonna aim for, or invest in, or look for, or anything like that?
I think one thing that's really important, I like to be just as unbiased as I can. In fact, the first thing I did when I left the oil field with the cash flow I had to support my lifestyle is I went to go work for like a Wall Street firm, a big brokerage firm. And I
Yep.
wanted to learn stocks, bonds, mutual funds so that I wasn't so biased, like the only thing I ever knew was real estate, even though I love it. And so I got licensed, and I went through the whole dog and pony show, and I just realized that I don't like it. It doesn't match my objectives, my risk tolerance. I hate the volatility of the markets.
Yep.
It's all surrounded by assets under management and clipping a big fee. And there's nothing wrong with that. It's just that the people usually advising you on what to put your money in, they're not putting their money in it. And it just felt very disconnected. I just
Yeah.
wasn't a fan of that system.
I
And
got
so,
a
go
I got
ahead.
licensed in a Series 3 several years
Okay.
ago, and when you look at that, and all right, so you made a 40 or 80 or $120 commission off of three contracts, and then you turn
Mhm.
around and tell the guy, hey, I need a $8,000 margin call. Yeah, there's a big disconnect, and then the options, and yeah, I'm 100% on board with you there. Absolutely.
Yeah, and so I guess where I was going with that story is that as an investor, if you're really going to have a true investor mindset, and by the way, Robert Kiyosaki talked about this about 2 years ago. He was at some event that I was at, and he was talking, and he said, people think of me as a multifamily real estate guy, and he said, I'm not. I invest a lot in that asset class, but it's because the leverage, the tax benefits, the
Yes.
cash flow. He said, you give me any other asset that does the same thing, I go invest over there. And it
That's
may
right.
not be multifamily.
Yep.
And so that's how I look at it too. I'm a big fan of what we're talking about on the show, but let's fast forward 10 years and say cap rates are at 1%, cash
Oof.
flows at 2%, and US Treasury bonds are at 4%. Well, I'm going
Yep.
to be a U.S. Treasury bond investor. I
That's right.
mean,
That's
I'm
right.
going to have
Yeah.
to pivot because it
Yeah.
just doesn't make sense. When you
Yeah.
look at the risk and everything, that you have to factor in. Ask me in 10 years. But, for the last 7, it's been amazing. I'm continuing to invest this year in value add multifamily. I still see some growth and some running room despite what's going on economically.
Yeah.
But that's just my opinion. I don't have a crystal ball. And so there may come a time I pivot. I'm a big believer, invest 80% in what you know and understand the best, and then invest about 20% is what I do in experimental things. Maybe
Okay.
it's cryptocurrency, maybe it's single family vacation rental, maybe it's self-storage, mobile home parks, whatever. So I invest in a lot of different asset classes, but most of it's multifamily, just because I know it the best.
Yeah, yeah, the value, and especially the value add part of it,
Yeah.
and everybody thinks that. I know it's a very simple business model. Sometimes can be very complicated to complete. So now, do you see there being alternative investments? You mentioned that there just briefly, and
Yeah.
I want to tie a little bit of your oil experience to the alternative investments. It's partially because where we're located at here, there seems to be a big push for like natural gas, like people are investing in natural gas wells and
Mhm.
such as so on and so forth. Do you have any experience in that kind of alternative investment stuff, like whether it be oil and gas, whether it be a road advertising? Yeah, I know a guy that's in an ATM fund. I mean, is
Sure.
that alternative stuff? What's your experience like in that?
Yeah, it's hit and miss, to be honest with you.
Yeah.
And I'm a firm believer that your risk goes down when you're investing in what you know and understand the best. I just am. That's just been my personal experience. The only times I've lost money is by putting money in something I didn't really understand.
Yep.
And almost every time I lose money, whether we're talking about, should I buy the stock right now? I don't know, but it seems like every time I do, the stock goes down, 15% right
Yeah.
after.
Yeah.
And now
Yeah.
I'm stuck holding the bag or taking a loss or whatever.
Yeah.
I lost money in this like debt collection thing years and years ago, a lot of money in that. And, but, to your point, yes, I invest in ATM machines, note lending, self-storage, mobile home parks, even publicly traded REITs and I'll tell you my philosophy on that. The publicly traded market, as you know, is very irrational. Sometimes it's down 20, 30%, like we saw in March of 2020, just because of uncertainty, not
Yep.
because fundamentals have really shifted, not at that point. So I was scooping up REITs that held multifamily and self-storage mobile home parks and stuff
Yeah.
that fundamentally hadn't changed. They were still getting their collections and their occupancy was still high. And so then we saw kind of a V recovery. Again, I couldn't have predicted that, but
Yep.
it's like you double your money in 1 year. I mean, it was a pretty solid
Well,
bet. So
yeah, the cash flow hadn't changed. I mean, they were
exactly.
still the only thing that really changed was the some of the moratorium stuff. But at
Yeah.
some point, you had to know that was gonna that the rents weren't going to be decreased. I mean,
Yeah.
all of a sudden it wasn't going to go down unless there was a commercial or something like that, possibly. But
Yeah.
nevertheless, residential, and that's brilliant, man. That's wonderful. And when you kind of step back and look at those alternative investments, it can be very daunting, like you said, when you invest in something you don't know. And I read a book several years ago called The Psychology of the Market, and I feel like when you know something, you understand the psychology, you understand what it takes for that business to tick every day, what
Yeah.
it takes to make that money, and that way then you know what points of analysis you need to pluck out and make sure that they're either in line or something you expect or have a potential to be raised. So I get that, and it really it's pretty good business plan. And I would advise anybody to understand the psychology of what you're investing in, and that's why a lot of stockbrokers get what they get, because they know what's going on. They understand
Yeah.
what makes that company tick. So,
Yeah. Yeah.
well, Travis, anything else you'd like to add or give to people to really understand? And then I'd like for you possibly to even discuss Ashcroft and how people can get in touch with you, and if they want to, of course, are you all doing 506B or 506C?
Well, Ashcroft's now doing 506C as of the last 2 years, so that means accredited investors only. It also
Yeah.
means we can talk about it on the show, we can advertise, so no legality surrounding that. So
Yep.
just from a high level, anybody listening, Ashcroft, really, the reason I've done so many deals with them, say I mentioned earlier, I've done 40, 50 deals in the space. I've probably done 13 or so with them. So not everything's with them, but they just match my criteria. So the
Yep.
criteria I shared earlier on the show of B class, value add, Sunbelt markets, monthly distribution. So they're doing a 506C fund, where they're trying to target 6 to 10 properties this year in fund number 2. And
Yes.
we're under contract now with the property distribution sometime in the summer, and monthly thereafter.
Awesome.
So if that's of anyone's interest, then that's what they got going on. And I guess what I'd like to leave with, from shifting away from that a little bit, is this. I just can't stress it enough, and I struggle sometimes with articulating big points that I think are so monumental for people to understand. But this buy low, sell high is just how most of us were brought up and taught. It's how Wall Street teaches us. But I'm telling you, you got to remind yourself of things like the lost decade from January 2000 to December 2009 in the stock market, where if you had said, I'm going to buy an S&P 500 index fund and I'm just going to diversify and be in the market with whatever account, there was a decade that went by with almost a 0% return, because it went down, it went up, it went down, it went up, it went down. You ended up at the same place a decade later with nothing to show for it, eaten up by inflation. So if you take that same decade and you say, what if I did a multifamily syndication. And just to be super conservative, if you had a 6% cash flow a year and it never changed for 10 straight years, never, in a flat or even a slightly declining market, you still were pocketing, $6,000 a year off a $100,000 investment, which would leave you at the end of that decade with $60,000. And so that's the way I look at it is I look at price and equity as a secondary factor. I look at cash flow as a number one factor. And like I said earlier, I never could have left a job I wasn't happy with if it weren't for cash flow and passive income being my primary emphasis. So I think that's really something to consider and to think about in your own portfolio or goals.
And I think it's Gene Trowbridge says, or told in, I think it was one of his books, or maybe it's only written one book, but either way, he said if you're buying or investing for appreciation, you will be out of business fairly quickly. I mean, it just doesn't make it. Don't get me wrong. Every once in a while, people hit and things go just exactly right. You buy, the appreciation is great, but if that's the only thing you're focused on, you have to have something to bridge that gap. So anyhow, well, Travis, thank you so much. How can the listeners get in touch with you if somebody wants to reach out and talk about investing with you or with Ashcroft or whatever, however, how can somebody get in touch with you?
Yeah, I open, myself as a resource to anyone and everyone in the industry, whether it's Ashcroft or not. And so I've put my calendar, we were talking about Calendly earlier before the show, but I put that on www.ashcroftcapital.com/Travis. You can book a 15-minute call with me, whether it's over Zoom or a phone call. Happy to answer any questions you have about any of this stuff. Again, it doesn't have to be Ashcroft related. And I'm all over social media. I'm on Instagram and Facebook at Passive Investor Tips. I'm on, Bigger Pockets, LinkedIn. I'm all over the place. So Travis Watts, WATTS. I'd be happy to help any way that I can for anyone that has an interest in cash flow investing.
Awesome, man. Well, thank you so much for your time. And again, Ashcroft is something, and you all are something, and a company that I've been watching from afar forever. And I can't tell you what it means to have you on here, so that we can meet and talk, and I can learn some of your philosophies. So hopefully the listeners learn some as well. And again, Travis, thank you so much for your time.
Appreciate it, Casey. Thanks
sir.
everybody for tuning in as well.
Yes, sir. See you later.
Cashflow Pro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.